Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. And let me tell you, Glacier Bancorp Incorporated's latest filing is a doozy. It is packed with numbers that tell a story, and today we're going to break it down so you understand exactly what is going on with this bank. Alright, so Glacier Bancorp Incorporated, or GBCI as they're known on the stock market, has dropped its quarterly report for the period ending the 30th of September 2025. And our job here at Corporate Decoder is to sift through all that financial jargon and find the juicy bits, the real insights that tell us how this company is actually doing. Let us dive straight into the numbers, folks. This is where the real story unfolds. The company's total assets are sitting at a hefty $29 billion, which sounds like a lot. And it is, but what is more interesting is how that breaks down. They've got about $854 million in cash and cash equivalents. That is up slightly from the end of last year. This is like the company's checking account, plenty of readily available cash, which is always a good sign, especially in uncertain economic times. Now look at their debt securities. They've got over $7 billion invested here, broken down into available for sale and held to maturity. This is like their investment portfolio, a significant chunk of their assets. And notice they usually invest in pretty safe things like us government and agency debt securities mortgage, backed securities, and corporate bonds. But the real meat of a bank's business is its loans. Their total loans receivable, after accounting for losses, stand at over $18.5 billion. That is a substantial increase of about $1.5 billion since the end of last year. That shows they are actively lending money, which is generally a good sign for a bank. You want to see that loan portfolio growing. And speaking of losses, they've increased their allowance for credit losses too. That means they are setting aside more money to cover potential loan defaults. This is a cautious move, indicating they might be anticipating a tougher economic climate, or simply being extra prudent, which is smart. The allowance for credit losses on loans is at $229 million. On the other side of the balance sheet, their total liabilities are just under $25.5 billion. These are the obligations the company has to others, like deposits they owe to customers and money they've borrowed. Deposits are the lifeblood of a bank, and Glacier Bancorp has over $21.8 billion in deposits. That is a significant increase of about $1.3 billion since the end of last year, and importantly, non-interest-bearing deposits. Those are the ones that cost the bank. Nothing in terms of interest paid, are up to showing customers trusting them with their money without demanding immediate returns. That is a positive sign. They've also reduced their reliance on FHLB advances significantly, down by about $904 million compared to last year. That suggests they are comfortable with their deposit base and might not need as much wholesale borrowing. Now for the owners, the stockholders, Glacier Bancorp has total stockholders equity of over $3.6 billion. This is the net worth of the company, the residual interest of the owners after all liabilities are paid. That is a healthy chunk, and importantly, it has grown since last year, indicating the company is creating value for its shareholders. Let's look at profitability for the 9 months ending the 30th of September 2025. The company reported a net income of $175 million. That is a solid increase of about $47 million, or 36% from the prior year. That is excellent growth and shows they are running a profitable operation. Their return on average equity is around 6.8%, which is respectable for a bank of this size. It means for every dollar of equity shareholders have invested, the company is generating a decent return. And for shareholders, that translates to a diluted earnings per S-share of $1.51. That is up from $1.13 last year, showing increased profitability on a per S-share basis. This is generally a good indicator for investors. Now for a bank, especially one like Glacier Bancorp, the difference between what they earn on loans and securities and what they pay on deposits and borrowings is crucial. This is called net interest income. For the first 9 months of 2025, net interest income jumped to over $622 million. That is a huge 21% increase from last year. What drove this? Well, interest income on their low. And investments went up significantly while their interest expenses went down. This is a classic winning combination for a bank. Their loan yield improved to 5.87%, which is a good jump, showing they are getting more bang for their buck on the loans they've issued, and importantly, their overall funding costs, including all those deposits and borrowings, went down too. That is a double win. And the net interest margin, that key metric for banks, is at 3.21% on a tax equivalent basis. This is a healthy increase from 2.70% last year. This means the bank is effectively managing its interest, earning assets and interest, paying liabilities to maximize profit. It is not just interest though, they also make money from fees and selling loans. For the first 9 months of 2025, non-interest income hit almost $101 million, up 4%. From last year, this includes things like service charges on accounts and gains from selling loans, which is showing a consistent revenue stream beyond just interest. However, running a bank is not cheap on the expense side compensation, and employee benefits jumped by 11% to $282 million for the 9 months. This is largely due to acquisitions they've made, bringing in more people and expanding their operations. And other expenses also saw an increase. This is understandable, given they acquired Bank of Idaho Holding Company, or Boyd, earlier this year. That acquisition alone added about $9.1 million in expenses. This is the cost of doing business and growing. So how efficient are they at turning revenue into profit? The efficiency ratio measures how much it costs them to generate a dollar of revenue for the first 9 months of 2025. It was 63.12%, which is an improvement from 68.98% last year. This means they are becoming more efficient at managing their cost relative to their income, which is a very good sign. Now let's talk about risk the allowance for credit losses, or ACL is the money they've set aside for potential loan defaults. This is a really important number for banks at the end of September 2025. This allowance was $229 million, which is about 1.22% of their total loans outstanding. This is a healthy buffer and an increase from last year, indicating prudence. Their non-performing assets, which are loans that are not generating income, are quite low at 0.19% of total assets. That is a good sign, meaning most of their loans are performing as expected, and they are managing their bad loans effectively. One area that is getting a lot of attention these days is commercial real estate, or CRE. Glacier Bancorp has a significant exposure here with over $12 billion in CRE loans, but they seem to be managing it well with a strong loan. 2. Value ratio and a diversified portfolio across different property types and geographic locations. They are also stress testing these loans, which is a good practice given the current economic climate. Like all banks, Glacier Bancorp is exposed to market risk, but their primary concern is interest rate risk. They use complex models to see how changes in interest rates could affect their earnings, and happily their simulations suggest that in most scenarios their net interest income will actually increase with rising rates, which is quite positive given the current interest rate environment. So total stockholders' equity. So looking at the overall financial health, the company's total stockholders' equity has grown to over $3.6 billion. This means the owner's stake in the company has increased, reflecting profitable operations and strategic growth initiatives like their recent acquisitions, and adjustments. So speaking of acquisitions, they've been busy the acquisition of Boyd in April, and more recently the acquisition of Guaranty Bancshares Incorporated, or Janty, on the 1st of October shows a clear strategy of expansion. This shows confidence in their future growth and their ability to integrate new businesses effective. LISO net income. So the company is showing strong profitability with net income up 36% in the first 9 months of the year. That is excellent news for shareholders and signals a well managed and growing business efficiency ratio. So their improved efficiency ratio from 68.98% to 63.12% is another win. It means they are getting smarter and leaner in their operations, which is always a positive indicator of financial health. Overall, Glacier Bancorp appears to be in a strong position. Their loan growth is solid. Their net interest income is growing, their expenses are being managed, and their capital base is robust. The acquisitions they are making are strategic and seem to be integrating well. The biggest risk, as always, will be the economic environment, particularly around interest rates and commercial real estate. But so far, they are navigating these challenges effectively. This company is definitely one to watch. Now, what's your take on Glacier Band? Core latest financial report. Did these numbers impress you, or do you see potential trouble ahead? Drop your thoughts in the comments below. If this deep dive into corporate filings was helpful, please hit that like button and subscribe for more breakdowns like this. And don't forget to join our Discord community for even more exclusive insights linked in the description. Thanks for watching, everyone. See you next time.